Is it? Okay.
But you can always start when you
Hmm. Okay. Right. So learning unit 6. Learning unit 6. What are we busy with there? Right. So I think this is actually going to be a very interesting learning unit. I'm yet to see learning unit 7, obviously, but I think so far, just looking at the content, I think it's actually going to be my favorite. Might be. We'll see, because it has options and whatnot. So I think we are going to thoroughly enjoy this learning unit. Well, maybe let me not say that now. Let me say that after we look at some questions and see. But yeah, it's entitled Leases, Hybrid, and Derivative Financial Instruments. Okay. And then just looking at the learning objectives. Okay, so we're obviously going to be looking at leases, lease agreements, and we'll also be looking at how to calculate the effect of taking up a lease. We're going to explain the advantages and disadvantages of leases. We're going to differentiate between hybrid and derivative securities. You guys did do options last semester, right? You did in accounting. Okay, all right. So you do have some knowledge on options. Okay, that's good. What exactly did you guys do in relation to options? Okay, like whether to actually exercise the option or not exercise. For bonds. Yeah, because isn't we talking about converting from a bond to shares, isn't it? So yeah, but that was like more that's so those are hybrid financial instruments because you're buying a bond, but then you can obviously then switch over to shares. Okay, but we'll touch on that. I just wanted to know what you guys do know and don't know. So first semester in finance, they never spoke about options in 3A. Okay, if you don't remember, it's fine anyway. It doesn't matter. It's not like this is too technical anyway. Then we're going to explain derivatives, look at derivatives, their function. We're going to describe convertible securities. We've spoken a little bit about that now. And then we're going to calculate the conversion value of a bond, all right, or the conversion value in a bond, okay, and then obviously the market value of a bond, and then explain key characteristics of stock purchase warrants, all right, and then also going to look at the implied price of a warrant, and what else is there? Defining options and so on and so forth. So, yeah, very interesting learning unit indeed. I just stand here up. So, as financial managers, our primary goal is to add value. How do we do that? By managing risk and return, right? This is the boring thing about finance. Every single financial module that you have had and are going to have, they are going to be discussing risk and return. I think as finance professionals, we're always interested in the return. Actually, I would say about 2 years ago, I actually realized because there is no return without incurring some level of risk, it really connected to how important actually understanding risk is. All right. And you find your best performing financial experts or investors, people like Warren Buffett, and the other guy, who's the other guy that comes to mind? Manages the biggest hedge fund. I'm forgetting Ray Dalio. They know how to assess risk. And by virtue of being able to assess risk, you know when you have a golden opportunity and obviously should invest to take advantage of the potential return. But anyway, coming back to our introduction, a hybrid financial instrument that has both debt and equity characteristics. So we're going to learn about that. Hybrid financial instruments include convertible bonds, preference shares, and warrants. Okay. A derivative financial instrument is an instrument that is dependent on fluctuations of another underlying asset. Anybody know what an underlying asset is? Underlying asset, okay. We'll discuss it soon enough, okay. But you can have the underlying asset being shares, interest rates, currencies, and market indices. When we're talking about market indices, we're talking about things like the top 40. Have you guys heard of the top 40 share index? So you can buy into the top 40. You also have the Aussie, which is also an index. I think you guys have definitely heard about this index. What do they call it? The Dow Jones. And there's another one, S&P 500. So those are the same as your all share and your top 40. Those are just obviously for America. If you go to England, you get what they call the FTSE. So anyway, moving right along. Derivatives are instruments used for speculative or risk management purposes. They are used to manage risks. Okay. Right. Then here they give an example. And they give an example of a manufacturing company based in South Africa that imports raw materials from a Chinese supplier. Now, by virtue of being a importer, all right, of goods from a different country, what are you exposed to? What are you exposed to? Tariffs, yes, taxes, import duties, all that kind of stuff. But in order to buy things in China, we're going to use rands in China. What are we going to use? Their domestic currency, right? Now, as a result of that, it means that our rands at different points in time are only going to buy us so much Chinese. What's the Chinese currency called?
Chinese yen.
What? One, I think, is Japanese. I don't know how to pronounce this. Is it renminbi?
No, so it's Japanese yen.
Yen. Oh, one is okay. I
One
think
is good.
Japanese yen. That's right. One, but one is there. I just don't know which Asian country that is. But it's definitely. Definitely. Okay, so the whole point being that as a result of trading with China, the rand at different points is either going to buy us more of their currency or less of their currency, depending on whether the rand has appreciated or depreciated against their currency. Okay, so that obviously exposes us to risk, because if at a certain point in time the rand is weaker than it was before, that means we are going to need more rands in order to buy our raw materials. Okay, so how do you then safeguard yourself against that? You can enter into a forward exchange contract. Okay, and a forward is a derivative. Okay, remember we said derivatives are used to manage risk. What risk are we managing here? Currency risk, exchange rate, exposure. Okay, right. So they're now giving you an example of where derivative would be used. Okay, but we'll talk more about that later on. And I think as we do exercise, it will make more sense. So let's look at the leases. What are they talking about in connection with leases? So a lease is it? Yes.
I used to think we need to buy things from China.
Yeah.
Where does the dollar come into the picture?
So you'll find that usually, sometimes countries will say we don't want that. So what you end up having to do is go buy dollars first. Then when you buy the dollars, then you can now buy the annual currency.
How would it come to?
there isn't like a huge demand for rands from their country. So maybe they don't have many people who are importing goods. We're based in China, we're importing goods from South Africa. Because demand for South African rands comes from either people who are buying goods from here or are coming to travel for tourism purposes. But there has to be some sort of demand for rands because we're buying or we're doing some sort of transaction with South Africa. Does that make sense? So if we don't transact with you, my friend, forget about it. You see. Very good question. Very good question. Okay. So coming back to lease, the definition that you guys need to have, remember they ask you to define a lease. A lease is a contract between a lessor, okay, the owner of the asset, and a lessee, in which the lessee is given the right to use the asset legally owned by the lessor in exchange for a series of lease payments over an agreed period of time. Now, I'm sure all of us know what a lease is, but just so you know the key words that you would obviously then use if ever they ask you to define them. So a lessor, as I mentioned earlier, is the person who legally owns the asset and is then supplying the use of the asset in exchange for the installments or the lease income provided by the lessee. The lessee obviously receives the permission and right to use the asset and makes lease payments to the lessor. Okay, right. So if you don't own your property, you are a lessee. All right, assuming you're paying rent, of course. So now here they give us examples of lease agreements. So you got your motor vehicles, land and buildings, office equipment, manufacturing equipment. When going through this whole lease thing, actually I had flashbacks of when we actually went through this thing. I can't remember if it was third year or second year finance on our side. Just in time. So here now they're just speaking to the provisions for a lease agreement. So obviously you have a lease term. How long is this agreement for? How much are we paying? All right, on each installment for the lease, and then frequency of lease payments. Is it monthly? Is it weekly? Is it bi-monthly? What's the story? Okay, or is it an annual subscription or payment, should I say? Who is responsible for maintenance and insurance? Very, very important. Okay. You'll find that most of the time when we trade in our cars, it's because the maintenance or the motor plan, as we call it, is done. Okay. Because that obviously is a cost in and of itself. And so most people don't actually want to worry about that. If your car breaks down when you have a motor plan, what do? Just say, hey, so and so, whichever dealership, come and get this thing sorted out for us. Okay, then purchase options. Okay, are we going to be able to purchase this asset at the end of the lease? All right, are we going to be able to purchase this asset at the end of it? Okay, right, then lease classification. You have operating leases and you have finance leases. Okay, now worth highlighting, you no longer have these lease options being applied in South Africa, all right, as of your IFRS 16. Did you guys play around with IFRS 16? What do you guys remember it being all about?
It's different last year, because last year we did actually differentiate between finance and operating leases, and we like learned how to account for them differently.
Yeah.
Whereas, like I think in the beginning of this year, we did leases, it was more so about like how much do you owe at the end of the period if you put deposits down.
And if you're paying X
Yes.
over the terms. Yeah. Okay, no, that's fine. So even here, we're not going to talk too much about that, but the whole point being that there's now no distinction between operating and financing leases. The leases will now treat all leases the same, unless you've got these two conditions, right? Or you're under these conditions. So exceptions to this rule, where leases do not capitalize, certain leases are So you've got leases of assets that are considered to be of low value, sorry. So less than 5,000. And then also if you've got a short-term lease, in other words, a lease that's shorter than 12 months. Okay, that's when you can maybe make it an operating or make it a finance lease. If none of those conditions apply, then it's just going to be a lease. Okay, so upon commencement of a lease. So the leasee will recognize a right of use of the asset and a lease liability that is equal to the present value of the lease payment. Okay, so there's obviously, these things seem very trivial to be discussing, but even when talking about the right of use of an asset, it gets deeper than just saying you have the right of use of this premise to bring students to come and conduct lectures. Within that right of use, there's also what you can and what you can't do. For instance, I'm sure some of us who are obviously staying on your own or renting, you know that your landlord might not allow you to play music after a certain time. If you're staying in a complex, you're not allowed to have visitors after a certain time. All right. And some instances, you may not be allowed to have people sleep over because obviously water and electricity are being used, so the right of use is not a given thing, okay? Because obviously there's a lot more detail to it, depending on the nature of the asset that you're also making. That is also being transacted upon, okay? Then obviously the period of the lease payments is obviously also ironed out. And very important, these are deductible for tax purposes, okay, those lease payments, okay. The finance charges due and depreciation will be expensed in the statement of profit and loss. Now, pertaining to the lessor, okay, the owner of the asset, the lessor is a party that legally owns the asset and transfers right of use of an asset to the lessee. Right, okay, so nothing new that they actually leasing. Okay, operating leases. Okay. So again, here they're going to tell you, or they're basically going to distinguish between operating leases and financing leases. But again, in reality, they are one and the same. Okay. So operating leases, obviously here there's no transfer of ownership. Okay. So me being the owner of this property, I still have all the benefits, all right, the rewards of ownership, and I also have the risk of ownership of having this property, right? So if it burns down, if I didn't have insurance, that's my problem. It's not your problem. Does that make sense? At the same time, if it increases if it appreciates over time, the increase in value, that's my reward, that's my benefit, okay? I'm an operating lease, because remember, you guys just have right to use the premise, you don't own the building. Then, under operating lease, the op obtains, sorry, I think they meant to say the lessee obtains the use of the asset without actually buying it, okay? Mentioned that the lease income received by the lessor is included in taxable income. That's on the side, obviously, of the lessee, okay, and is recognized as a lease income in the statement of profit and loss and other comprehensive income on a straight line basis. Okay, right. So they're basically saying you can, as a business, leasing a building as a lessee, you can obviously include that payment in your income statement. Obviously, it's going to be an expense on your side. Okay. Now, a financial lease. Here, the lessor transfers the right to use an asset and transfers all the risks and rewards of ownership. So in other words, what we're saying is there is now a transfer of ownership at the end of the lease. Okay. The lessor will usually be an independent leasing company, okay, a bank or a similar financial institution. Right. If you guys have been involved in buying a car, I'm sure some of us have, all right, you'll find that you go to a dealership, they say, okay, this is the car that you want, no problem, let's sign the paperwork. But the financing of that car, assuming that you actually didn't pay cash, they'll say the financing of our vehicles happens with Westbank. So in other words, can you see that Westbank is basically leasing you the car? Okay, although you bought it from a dealership, can you see we're now introducing a third party into this equation? There's obviously you, people you're buying the car from, and then Westbank. Okay. The risks and rewards of ownership usually pass to the lessee at the end of the lease term. All right. Or the lessee is given the option of buying the asset at the termination of the lease at a bargain price. I've never really looked at this rent to buy story. Have any of you been exposed to rent to buy contracts? Okay, so I think it's a similar principle where maybe, let's say you have gone into an agreement to rent a property, then I think at the end of that year, you have the option to potentially buy the house from whoever is, whoever your landlord is. Okay, right. So the leased asset should be of specialized nature in a way that only the lessee can use it without major modifications being performed on it. Okay. Emphasis there on should, doesn't necessarily have to be the case. Okay. The lease term is substantially equivalent to the useful life of the leased asset. Now, this is something worth noting, okay? Because usually you'll find that at the end of the lease, the asset may be, it may have depreciated entirely, okay? So that's why we structure it for the length of the useful life of the asset. The characteristics of a financial lease are similar to debt financing because the value of the lease payments will ensure that the lessor is reimbursed for the cost of the asset plus interest over the lease term. Okay, so once again, that's connecting very well to the fact that we usually structure your financing lease according to the lifetime of the asset. Okay, then here we have a direct lease, and direct lease, we're just saying the person who is leasing you the asset also owns the asset. When we talk about a sell and lease back agreement, we own the asset, we sell the asset, all right, to a leasing company that then leases the asset back to us. Why would you do something? Why? Because this thing only makes sense when you understand why you would do something. And I can't go to the next slide for you. I haven't seen like this question. So in a sell and lease back agreement, right, or an arrangement, we have a situation where I own the asset, right? You're a leasing company. I sell it to you. So it's now your asset. But on the agreement that you lease it back to me. So I'm now using it. You're definitely trading, right? Has something to do with cash. Because remember, when you own an asset, right, you're not earning any money off of it, isn't it? Right? So by selling the asset to you, you're giving me money, which is releasing cash into the business. Can you see that? And then I'm just paying an installment, which is significantly less than whatever I sold it to you for. So that's the whole logic of a sell and lease back arrangement. Okay. So here it says is a transaction in which an entity, that being me in this example that I gave, sells an asset it owns to another party, okay, and at the same time leases the same asset back from the buyer. Okay, this allows the seller lessee to obtain cash from the sale while continuing to use the asset under a lease agreement. Honestly speaking, I think you would do that if money is tight. Does that make sense? I think you end up doing that when money is tight, and obviously you're looking for creative ways to get some cash into the business. Okay. Then a leveraged lease. Okay, so here we're referring to a lease agreement that is partly financed by the lessor through a third-party lender. Okay, so we have three parties, and I like to use the car illustration. Okay, so you've got Aubrey dealership. Okay, I'm the lessor. Okay, I have partly financed the vehicles that I'm selling to the public. I've only paid 50% on all the vehicles that I own. Okay. And then you come into the dealership, you say, I want that car, I sell you that Lamborghini, right? I've only paid 50% of the Lamborghini. By way of your installments, I'm going to be then paying to West Bank the installments on the 50% I still owe. Does that make sense? And then what we also then do is we say, if I fail to pay West Bank, right, the third party, then they are entitled to your installments. Does that make sense? Okay, right. So those are our different types of lease arrangements. This is just reiterating the same thing in different wording, just to try and make it a little bit easier for you guys. Why are we learning about lease? What is the purpose of us learning about leases? Because what is a lease? We're basically saying we want to be able to use this equipment, want to be able to use this property, right? But we don't necessarily want to own it. What would make us decide on whether to own the asset outright, okay, or to actually just have right to use it? Cost. Thank you. It's about cost. This thing is about cost, okay? If we just rent the asset, in other words, lease the asset, all we're doing is we're paying a installment, okay? And depending on what we agreed, we might not be paying in payments. So if this thing breaks down, you just make a phone call and someone must sort it out. But if you own it, you must fix it, okay? But then we have to assess. Maybe it's cheaper for us to own it. And the thing is brand new, so it's not like it's always going to break down. So that moment in time when we do have to improve or when we do have to do some maintenance might not be as significant as actually looking at how much we actually incur, if we were to actually lease this thing over a fixed period. Remember, when you go into that agreement, it's going to be difficult for you to just jump out, typically, okay? So when you get into the lease agreement for 24 months, chances are you'll be stuck in it for 24 months. Does that make sense? Right. Oh, by the way, corporate leases, for instance. So if we had to go rent a building in Sandton for whatever business we are conducting, you're in it for 5 years. Okay. So just showing you that when you're in a lease, you're kind of locked in. So all that I'm trying to highlight here is our reasons for actually looking at leases is because we're trying to assess costs as financial managers and say, what is the better financial option for us as a business? Is it cheaper for us to lease this piece of equipment, or is it cheaper for us to just buy it outright? Okay. And also, if you don't have the full amount upfront, should we go into some sort of installment plan? Is it cheaper to buy it through financing, or let's just lease this thing? How do we then calculate which one is cheaper? How do we assess the cost? It's literally us looking at your NPV. So the lower NPV, the better. Because remember, this is now us taking out money to either buy or lease. So it's money leaving us. So the lower the MP, the better for us. Okay. So obviously to do your NPV calculation, you need to know all the cash flows related to your respective option. And so here they're just breaking down the steps in terms of identifying the least the least cost financing option. Right. Okay, so here they're saying a company that is the lessee of a finance lease is required to disclose various details relating to the lease, which include, right, the carrying amount of right of use of the asset at the end of the reporting period, the depreciation that has taken place on that asset, all right, then interest expenses on lease liabilities, and then a maturity analysis of lease liabilities. Right, now we speak to the advantages, okay? Deductibility of lease payments, okay? You can take that as expenses, which is obviously going to reduce your net profit. Remember, what do we pay tax on? Our net profit. So the lower our net profit is, the lower our tax liability. Can you see how that's an advantage for us? Okay. If you were to buy the asset outright, that's going to affect only your balance sheet. It's going to increase your assets. But does that bring money in? No, it doesn't. Okay. Then avoid issues and costs associated with asset obsolescence. And then increase financial flexibility. I think we've spoken to that. And then avoid restrictive covenants associated with long-term borrowing. What type of restrictive covenants are we talking about? Borrowing from banks, isn't? You may find in order to purchase, you may need to go and borrow from the bank because you don't have the full amount. So we may have entered into certain agreements with shareholders to say, no, for us to actually invest in this company, you can't go take out any debt for the next 3 years. So in order to ensure that we meet that restriction, what do? We go and get a lease because we need this equipment. We need printers. How do we educate kids without being able to print? Okay. Then security. Okay. Security. Right. Okay. So let's go on. Then there's obviously disadvantages of leasing. The lease is a long-term expense. Remember, I told you it's not easy to just jump out of this if you decide you no longer want to be leasing this asset. Then the lease payments do not contribute to a business assets or capital growth, okay? And the lessee does not obtain any benefit from any appreciation in the value of the asset, okay? Right. The lessee may have limited control over the maintenance and the ability to make improvements to the lease property. What are we talking about here? If you're renting your property, can you just renovate? You can't. You can't. You have to ask for permission, and you may find that also the other issue is they might very well be happy for you to do whatever you want to do, but then there's also the issue of who is your supplier for that, let's call it a marble table that you want to put in the kitchen, right? Because they must also agree to the quality, right? Because at the end of the day, you're just renting for this year, and after that, you're going to move on, but they're stuck with whatever you've done, isn't? So that's what we're talking about over there. And by the way, any improvements that you do to your house, they're for the benefit of the owner. So they're not for the benefit of you, the person renting, even if you're the one who actually paid for those improvements. So be mindful of that. The lessee may still be required to satisfy a lease obligation, even if the asset becomes unusable and obsolete during the lease term. So again, you can see that's speaking to Once you're in the contract, it's difficult to get out, even if the asset is no longer usable. So you need to really think about it before you jump into a lease agreement. Then we jump into options. We jump into options, and I'll just read this slide, or we'll just look at this slide, and then we'll take a break. So, what are options? An option gives, well, firstly, it's a derivative financial instrument. Okay, so if ever they ask you to define an option, you need to say it is a derivative financial instrument. Okay, and what does this instrument do? It gives the holder, in other words, whoever owns the option, the right. Okay, emphasis on the right, but not the obligation. It's not a must. Okay, to buy or sell a number of units of an underlying asset at a predetermined price. Anybody want to unpack? What did we say was an underlying? Or maybe let me take 2 steps back. When we say you have the right but not the obligation,
At your discretion.
it's at your discretion. Very important. You have the option. That's why we call them options. You can buy this or not buy it. You can sell this or not sell it, depending on whether you feel it's a good idea to act or not. Does that make sense? So that's what we mean when we say the right and not the obligation. Okay? To buy or sell, pretty straightforward. What do we mean when we say underlying asset? This is where the concept of derivatives. Where does the word derivative come from? Derive. Okay? What did you say? Mad. That actually isn't wrong. Okay. Hey, and this is the worst type of math. Hey, you guys. I used to think I was good at math until I met these things. And yeah, it was a good wake up call, a humbling. Okay, so derived. Why was I emphasizing or want to emphasize that word? Options or derivatives are not, they are assets, but they're not assets in and of themselves. They derive their value from an underlying. Are we together? So an option, you have the option to buy Apple shares. That means you have the right to purchase Apple shares at a certain price for a certain period of time, isn't it? So, can you see the value of the option? The premium you're going to pay to buy or own that option is going to be based on the value of an Apple share. Can you see why we call it derivative? It's deriving its value off of the value of a Apple share. And I'm obviously just using Apple share as an example of our underlying asset. Another underlying asset could be a specific property in a specific neighborhood. The underlying asset can be anything. Does that make sense? It can also be a exchange rate. You buy the option to receive rands at, let's say, receive dollars at 20 rands per dollar. Can you see you're locking in that price? All right, for a certain period. Can you see this option is going to derive its value from the currency exchange rate that you've locked in, which is your underlying. Okay, so is the whole derivative or deriving now making sense? Okay, right. OTP. What is an OTP? I know I have property purchase. Well. Depending on who are you looking Are you looking at the owner who is looking to sell? Or are you looking at the person who provides the offer? Absolutely. So you gave me an offer to purchase.
So, position given by the seller.
It's given to the seller from the bank. So let's do it like this. Who are you? Are you the person buying or selling the property? You're buying. So I'm the seller. I have the property. It's in my name. Okay. So you give me an offer to purchase. We together, right? Now, as the owner, I have the right, not the obligation, to either accept his offer or decline it, because I'm in ownership of the property, isn't it? Not so. So you can think of it as an option for me, but it's not an option for you. Because offer to purchase, and I know you know this, offer to purchase actually locks you in. You are now stuck. Even if you like 2 days later, like, actually, that was a bad investment, or I actually realized there are better properties that I could have bought. You are stuck because you signed on that document. Unless that one did not lock you in, but typically an offer to purchase locks you. So people will often tell you, don't give an offer to purchase unless you are 100% sure you know. So it's not an option for you, because it's an obligation on your side, but it's an option. Let's just finish this and then I'll give you guys a break. The issuer or seller of the option has a corresponding obligation. Can you see? You issued the option. So you have an obligation to me. If I choose to exercise, you must provide the capital for the property. Okay? So that's what we mean. Has a corresponding obligation to sell or buy the underlying asset when the holder of the option chooses to exercise. Yeah, I've chosen to exercise my right to sell it to you. Makes sense. Awesome stuff. Okay, so let's take our 10-minute break. And then if we can be back by 2:15, we'll finish off the slides and call it a day. Anybody who wants to see their muck, you're more than welcome. You can.